Okay, today we're going to talk about how to analyze the Forex market using parallel and inverse currency pairs or currency pairs from the same with one common currency. And this is part of our 35 Forex lessons at forexearlywarning.com. Okay, so if you don't understand parallel and inverse analysis and you want to trade the Forex, you will more than likely fail. You can learn parallel and inverse analysis in an extremely short period of time, and it'll completely transform your Forex trading. And by focusing on the individual currencies, you'll basically just start making pips, and you will have much more confidence when you enter trades. We're going to learn how to analyze the Forex market with trend indicators and also with real-time indicators. Okay. So parallel and inverse analysis is the study of how individual currencies influence the movement of pairs. And so that's pretty simple and straightforward. And for the purposes of this article and lesson, we're going to consider the 8 major currencies. These are the 8 currencies that are the most frequently traded. You know, the US dollar and the euro and the British pound. Here's the list right here. It's 8 currencies, and we're going to focus on 8 currencies and 28 currency pairs. So let's look at this simple but really great example of how to group your pairs. When you're setting up your trend indicators, or if you're setting up your real-time indicators, you want to do it in this fashion here. So that way, if the euro is strengthening, you can see that the euro is consistently strengthening across the 7 other currencies. That you have euro strength, and you want to start considering maybe buying the euro USD or buying the euro dollar Canadian. So if they're all going up and trending up, then you got a real shot to make some pips. Similarly, this and the euro is the base currency, and the yen pairs, the yen is the cross currency on the right. So if the yen is strengthening, all these pairs would be dropping, or red, or pointing down on the trend indicators. So you got to get used to the positioning of the, and look, this is a nice parallel, all in parallel. Well, this one's in inverse, parallel and inverse. So this is the New Zealand dollar. Now in the New Zealand dollar is the base currency on some pairs, and it's the cross currency on the others. So if the New Zealand dollar is strong, these 4 pairs will be rising and these 3 will be falling. So for each different one of these currencies right here, these 8 major currencies combined into 28 pairs, you're going to have to get used to some of this, but it'll only take a couple of weeks and it will completely transform your Forex trading. You'll set up your charts grouped together this way, and you'll set up your real-time indicators this way. So let's go through a couple of simple examples. So if the Euro USD is rising and the USD Swiss is falling, obviously the USD weakness is controlling the movement. Okay. But if the Euro USD is rising and the USD Swiss is rising, this cancels out the US dollar. It means the euro is strong and the Swiss franc would be weak here. Therefore, the best pair to trade would be to buy the Euro Swiss, because the Euro USD and the USD Swiss don't always move in the same direction. They might be moving because the USD is strong or weak, but they also might be moving because the euro is strengthening and the Swiss franc is weakening at the same time. So you got to, this is just a simple 2-pair example. We're going to get into some examples where you're using the entire market to focus your energy onto what pair to trade. But a totally simple example using 2 pairs, the Euro USD and the USD Swiss, to determine if you should buy the euro, buy the USD, sell the USD, or even possibly buy or sell the Euro Swiss. Because if you take out the USD out of both pairs, you wind up with the Euro Swiss. Just brutally simple, but most Forex traders don't use it. They just simply don't. Now here's more examples here using different pairs, and we'll show you what pair to trade with these basic simple examples. Okay, now let's analyze some trends using the same principles. So our example is going to be the euro against the yen. So if the euro is dropping against the yen, let's say on the H4 or D1 time frame, and it drops for like 7 or 8 days, there's only two reasons the euro yen can drop. This is the euro Japanese yen. It's either because all the euro pairs are dropping or all of the yen pairs are dropping, which means the yen is strong. And then they all come down and hit a support level. So all you have to do is set up your charts and analyze all of the euro pairs over the same time frame and all of the yen pairs, and you'll figure out why this pair is dropping. It works the same way for every other pair. So set up all your euro pairs together or set up all your yen pairs together, and you can analyze the euro yen very quickly against the other 7 major currencies. Let's move down the page here a little bit. So the euro yen hits the support level and then it starts to rise off of the support. Okay, why did the euro yen go up? Well, it was because all of the euro pairs started rising or all of the yen pairs started rising, which means that the yen would be weak. So if, once again, if you set up all your euro pairs together and all your yen pairs together and look at the euro yen over the same time period, you'll figure out why the euro yen reversed off of the support. So we analyzed the trends of the market with individual currencies in parallel and inverse analysis. So let's now talk about individual currency strength and weakness. So almost all Forex traders use technical analysis, but technical indicators, the standard technical indicators, are completely worthless because they don't consider the individual currencies. So you have to, there's over 150 technical indicators and over 100 candlestick charts, and none of them take into consideration individual currencies. If you apply technical indicators and candlestick charts to your Forex trading, you will fail, you will lose, and you have to start dividing each currency pair into 2 separate currencies to make progress. So every currency pair consists of 2 items, the base currency and the cross currency. The Euro USD is composed of 2 individual currencies. So what you have to do is you have to analyze the Euro and the USD separately. The Euro and the USD have to be analyzed completely and totally separately. Then the analysis of the Euro and the USD together will give you the correct analysis of the Euro USD. Okay, if the euro is strong, for example, and the USD is neutral or weak, then you want to consider buying the euro USD. In no other situation should you do that unless maybe if the euro is weak and the USD is strong, then you would want to sell the euro USD. This logic works for every pair. It works in almost every situation, and combined with some good money management program and trend analysis, you'll have yourself a fantastic trading system. Okay, sometimes the market is not trending and you get into a ranging market where the market is ranging and choppy. So if you pick an individual currency pair and, you know, one day one currency is strong, the next day the other currency is weak, and it just goes on and on for cycles, here's what's happening. If you look at a chart and you detect that many pairs are choppy, it's pretty simple. You can just move to another pair. For example, if you look at all the USD and Swiss pairs and they're messed up and choppy and you're looking to trade the USD Swiss, you have to wait. So what you do is if the US dollar is strong and the Swiss franc is strong, if both currencies are strong, or if the USD is weak and the Swiss franc is weak, if both currencies are weak, in a choppy market, both currencies might be strong and both currencies might be weak in the same pair. That's what creates the choppiness because you don't have any differential to cause the pair to move. But in this case, because we trade 8 currencies, what you would do is you would just abandon the USD pairs and the Swiss franc pairs and just move over to some other currencies and to see what's going on there. So this now, the same thing happens if the pair is trending. If the USD Swiss looks like it's in an uptrend, just check all the USD and Swiss franc pairs and you will quickly determine if the USD strength is pushing the uptrend or the Swiss franc weakness is pushing it. And with this knowledge, your trading confidence will skyrocket. Parallel and inverse analysis works. Now let's move on to using parallel and inverse analysis for trade entries. This is a real-time tool called the Forex Heatmap. And what it does, it's arranged, this is the Canadian dollar pairs here, and it's arranged using parallel and inverse analysis. This is a real-time indicator to help with your trade entries. For example, if the Canadian dollar is weak on 7 out of 7 pairs, so if these 4 are green and these 2 are red, that means that the Canadian dollar is weak, and you can look at maybe selling the Canadian dollar Swiss or buying the New Zealand dollar CAD or buying the USD CAD, because you know that the Canadian dollar weakness is pushing the market. If the USD CAD or New Zealand dollar CAD is in an uptrend on an H4, D1, or W1 time frame, you can get right into these pairs on the Canadian dollar weakness, and you will now be trading in the direction of the trend, and you'll have trade entry verification by all of the Canadian dollar pairs. This is, they always say the Forex is a $6 trillion a day market. You've got billions and billions of dollars pushing the Canadian dollar here, and you're going to get into the same trade indicated by the market momentum and our great tool. This is called the Forex Heatmap. You can learn more about it on our website. So now you can use parallel and inverse analysis for trade entries, and also, as we showed you in the charts, for market analysis. The power of parallel and inverse analysis is endless. So the vast majority of Forex traders, almost all of them, they don't know what parallel and inverse analysis of currency pairs is. They don't analyze individual currencies. They just basically, it just kills their trading. They go straight into the technical indicators. They completely ignore the individual currencies, and it just blows up their trading, and they have absolutely no chance to succeed. If you read this article and watch this video over and over, it will completely transform your Forex trading. So this is our lesson. This is lesson number 8, actually, in our 35 Forex lessons. This one lesson will transform your Forex trading completely. And this is Forex analysis, real time, and using trend indicators, using parallel and inverse currency pairs.